You've also mentioned this, the spreads are so tight on high-yield bonds. There is a bubble here.
Well, potentially there's a bubble there. We have forced interest rates so low through quantitative easing and purchasing of treasuries that you would you've seen a creep into other asset classes as people have looked for yield. 10-year notes yielding less than 2% now. They've reached out the spectrum to buy stuff that has yield, which has been high-yield bonds.
And that's really the issue, right? Because there are just too many guys who've jammed into that thing. What happens when they all try to leave, Brian?
Well, the problem is what happens when the Fed actually stops purchasing. If you normalize rates some, you'd expect that 10-year notes might go from 2% or 180 to 185 today to maybe 3%. And if you saw that move, what would happen to high-yield bonds in that process? Clearly, with the Fed buying and keeping interest rates really low, the exit strategy or maybe lack of exit strategy is what's going to be really interesting.
But let's say there was a big this and you did see this potential bubble burst. Is it as damaging to the economy as the stock market bubble bursting or commodity bubble bursting?
I'm not an expert in high-yield bonds, but I think the breadth of investors in high-yield bonds is probably smaller than we see in the overall equity market. So I don't know if it would cause that kind of damage, but certainly you have to be aware of bubbles. And if you look at the history of Fed, I don't think a Fed policy has ever come out and said, let's get ahead of this bubble.
Sure.
We anticipate this and this is what we need to do. Unless you're talking about a spike in inflation where the Fed will be very proactive, it's very difficult to see a situation where they'd say we are doing these steps to try to pierce a bubble happening in high-yield bonds.
Yeah, right. Hard to know in the moment that you actually have a bubble. Wasif, from your perch, where you sit down in San Antonio, Texas, any bubbles that you see at the moment?
It doesn't seem that way, although I agree with Brian that the Fed didn't recognize the housing bubble or the tech bubble for that matter. So I wouldn't look to the Fed to tell us if we're in a bubble or not. From our standpoint, it doesn't look like we're there in any particular asset at this point. With respect to bonds, when you go back in history and you look at the 1930s, for example, or Japan recently, or even back to the 1890s, interest rates in a post-balance sheet recession, i.e. in a deflationary environment, tend to stay low for a very long time. So while interest rates are low, they may stay low for a lot longer than we think.
Brian, that's a great point. Can you comment? How long could rates stay low in this environment where Bernanke says unemployment is still way too high to justify a change?
Well, if we don't get a big change in employment that allows the Fed to move away from quantitative easing, you have to expect they'll continue to purchase. They have a balance sheet now of $3 trillion, expected to go to $4 trillion. Where does this all end, and when does it end? The problem is exit strategy was something that Bernanke touched upon today, that there really is no exit strategy, that perhaps we could raise interest on reserves, but there's no sense that there'll be some scale selling of assets that the Fed has accumulated. Over time, bonds move towards maturity, and obviously the average life of the securities they own will start to roll off over time. But it's a very tricky situation. Once you've bought $4 trillion worth of assets, is there any reason to think you can't buy more?
Well, I'll tell you what, let's listen to the chairman's own words on exit strategy. Here is Chairman Ben Bernanke speaking earlier today in front of the Senate Finance Committee.
What would the impact be of actually having to liquidate a big portion of your holdings on the bond market, on the equity markets?
We don't anticipate having to do that. We think that we can.
Not ever?
We could exit without ever selling by letting it run off, and we could tighten policy by raising interest rates that we pay on reserves. That would be one strategy, for example. In any case, we have said that we will sell slowly with lots of notice. And we will, of course, also be offering our forward guidance about rates so that there will not be a shift in rates expectations on the part of the market.
So there you have it. The chairman making very clear, Betty, they're going to let the bonds effectively mature. At least that's one possible scenario. Number one, let the bonds mature. And number two, start raising the rates on deposits that banks make at the Fed.
That was an interesting strategy outlined by the chairman. I want to bring Wasif back in to the conversation because Wasif, as you said, it doesn't look as if there are any bubbles forming at this point. In the meantime, does that mean it's all clear for risk assets like the equity markets then, Wasif?
Well, if you go back since they started QE, you can make the case that risk assets have had a really good run. But if you go back to 2010, 11, and 12, every year has sort of rhymed in a way where we do get up some optimism in the beginning of the year, and then there's usually a summer swoon caused by some kind of a concern, whether it's a crisis in Europe or an economic slowdown in the U.S. And then towards the end of the year, we have that follow-up by the central bank saying everything is okay because we stand ready to provide liquidity, and that pushes the market higher. So to answer your question, Betty, in the long run, we think that risk assets may continue to push higher, but that doesn't mean that it's not going to come without any volatility. Volatility will continue to play this hide and seek. It was really suppressed for a while. And we were buying volatility when the VIX, for example, was very, very low, because we see it as an asset class. And now this resurgence in volatility is letting us sort of take advantage of that in a way. So all of that return may happen over time until we do get to a point, as Brian mentioned, that the exit strategy is going to be very critical.
Yeah.
So the Fed can either be too early or too late. And we think, given their history, they're probably going to be a little bit too late and spur some inflation.
Brian, so that being the case, what do you do? You're the head of interest rate strategy at Cantor Fitzgerald.
The Fed is still in buying tremendous amounts of securities. In the long end, it represents almost 90% of outstanding supply. So every day the Fed is in buying. It's hard to be short. We set up early this year where it looked like we're going to move towards much higher interest rates. We got 10-year notes back to 207. We got long bonds back to 325-ish. And now we've seen a big rally since then. So it's difficult to fight the Fed. I think people are waiting, being patient. I think there will be a time when the economy picks up or the Fed is going to stop their purchases where there'll be a time to be short the market in a big way.